Good evening, everybody. This is Reza, and it's Caleb Financial Borrow to Invest webinar. Welcome, and I hope you enjoy the webinar. Let's start. Before I start the presentation, I just share with you some market updates. What happened in the marketplace in Canada last week. Let me share with you my screen. Okay. This is the oil, US oil, and as you see, it's bouncing back a little bit. And yeah, because oil is the most important thing right now, I'm sharing this chart with you. First of all, I'm not talking about US oil or any speculation. I just want to provide you a kind of market update today. What happened last week? Maybe the most important thing happened yesterday was the news we had in terms of capital gain tax. As you know, liberals kept the capital gain tax as is now, which is 50%. And a lot of speculators were speculating that they are increasing capital gain tax to 66.67%. or even worse, 75%. But thanks God, and thank you liberals, they kept the capital gain tax the same, which is 50%. And during the presentation, you will realize why the capital gain tax is so important. The rest of the week was a kind of peaceful, let's say. The only news we have was on Friday, and the core retail sales was increased to 1.2%, which is really good. So after these good news, let's start the presentation. Okay, let me. Okay, there you go. Borrow to invest. Borrow to invest or leverage is one of the most beautiful concepts I have ever seen in the finance. You know me, I love finance, and investments are one of my favorite areas. So let me share this slideshow. There we go. Okay, borrow to invest or leverage. In this presentation, I'm going to share with you this beautiful strategy, borrow to invest or leverage, plus a short overview of guaranteed investment funds or segregated funds. Market update, we already covered that. And disclaimer, first of all, it's not a tax advice. Talk to your accountant before making any decision. This presentation is just for illustration purposes, and I'm not a tax expert. I just show you the blueprint of what your products are gonna do, but you for sure, before implementing any kind of a strategy, you need to talk to the accountant and confirm everything with him or her. And before doing any kind of transaction, we need to sit down together and discuss all the details of this strategy. Before I start, I just show you a very short video about borrow to invest, and you will have an idea about what we're gonna do tonight.
For over 20 years, B2B Bank has been offering investment loans to Canadians to help build wealth and make their financial goals a reality. So what is investment lending? In simple terms, investment lending is borrowing money to invest. similar to a mortgage or an RSP loan. An investment loan allows you to borrow a lump sum of money upfront to invest in assets. This strategy means that these assets have the potential to increase in value over time, helping you achieve your financial goals sooner. How does it work? When you borrow to buy an item such as a car, your money is going towards something that decreases in value over time. However, when you borrow to invest, you are purchasing investments that have the potential to grow over time. Potential benefits to investment lending: accelerated savings through a lump sum investment with greater potential for compound growth. Generally speaking, interest paid to borrow money to earn investment income is tax deductible. When the interest is deducted, it can be an effective way of reducing the overall cost of an investment lending strategy. What are the risks? An investment loan, when used properly, can be a powerful wealth-building tool, but it does pose an element of risk and may not be suitable for everyone. While investment loans have the ability to accelerate gains, they also have the potential to magnify market losses, depending on how the investment performs. Is an investment loan right for you? In general, investors who may benefit from this strategy will have available cash flow, a high risk tolerance, a long-term investment horizon. If you think borrowing to invest is a strategy that could be right for you, speak with your financial advisor today. To learn more about B2B Bank investment loans, visit b2bbank.com/borrow to invest.
Perfect. This short video is provided by B2B Bank, which is one of our partners and one of our lending partners. And they are one of my best favorite partners because they lend money very easily. And you see the logo of Bank of Montreal on the right side of the page. That's because I love BMO guaranteed investment funds. Okay, let's continue. Why do we get a loan? Typically, we get a loan for two reasons. The first thing is to buy a ticket item, such a car or whatever, and the other purpose we borrow is to invest. We borrow money and we put the money in an investment which potentially grows over time. And the market appreciates and we get some capital gain, like a home or mutual funds, segregated funds, stocks, gold, commodities, whatever. Okay. What's an investment loan? With an investment loan, you borrow a lump sum money from a bank and you purchase an asset which potentially grows over time. And there are tons of facts and myths around borrow to invest. Let's start with the myth. Okay. Yes. Let's start with the myth around borrow to invest. The first thing is leverage is just for the wealthy people. That's not true because the thing is everybody can use this strategy in whatever scale you can imagine. The second myth is all debts are bad. I don't want to argue about why debts are good or why debts are bad. I just want to share with you what Robert Kiyosaki says about the debt. Good debt is a powerful tool, but bad debt can kill you. And Robert Kiyosaki is one of my favorite authors. Okay. The third myth is leverage is too risky for me. The thing is, I don't want to say that leverage is not risky, but I just want to compare the leverage with other kind of investments like purchasing a house. Most of us has invested in real estate, and what we do is we get a mortgage, we invest something like 5 to 10% as down payment, and we get a mortgage, and we collateralize technically the equity inside this investment to borrow. And let's analyze what risks we are exposed to when we buy a house. The first thing is purchasing a house is a highly leveraged equity investment. God forbid, if something happens to the investment, the bank can confiscate the home equity and all the investments, and it's a secured line of investment, kind of investment. The other thing is buying a house is a non-liquid or poorly liquid transaction, because if the market is down, if we are facing a recession, it's very hard to liquidify this investment. And there is no diversification. When you invest in real estate, there is no diversification because you are exposed to a local risk. So you don't know what's going to happen in other areas, and there is no diversification involved when you buy a real estate. And the deductions are not tax deductible. The interests are not tax deductible. When you get a mortgage, the interests are not tax deductible. On the other hand, when you borrow to invest, all the interests are tax deductible because you borrow to invest in an investment vehicle. And most of us have a low expectation for returns of real estate. The fourth myth is the return of investment should be higher than the cost of borrowing or the interest to make this strategy profitable. That's not true. There are several reasons why even the interest rate or the cost of borrowing is equal to the return of investment, you can still make money. The first thing is capital gain tax, because the tax treatment of capital gain is quite different comparing to other tax treatments. The capital gains are subject to tax just up to 50%, which is really good. And that's why at the beginning I was very concerned about the capital gain tax changes yesterday. And thanks God, the liberal government kept the capital gain tax the same, 50%. The second reason why, even with a return equal to the cost of borrowing can make money, is the interests are tax deductible when you borrow to invest. So there are a lot of terminology around this strategy. I just don't want to waste your time, but just keep in your mind, break-even point definition is the minimum return needed to cover the after-tax interest expense and start profiting from leverage. So we have to compare every single scenario to see what's the break-even point for the investor. And the facts. It's obvious borrowing to invest is smarter than borrowing to spend. Everybody knows that. And this is the key. And I have to say that you have to check it with your accountant that the interest on an investment loan are tax deductible. Canada Revenue Agency has the right to change it at any time. But the thing is, it's not easy to change because it affects the economy so much if it happens. What are the benefits? What are the benefits of borrow to invest? The first thing is investment loans can be an alternative or a complement to traditional investment strategies. Investments have the potential to accelerate your to reach your financial goals. Keep in mind, it's like a magnifier. Borrow to invest can magnify your losses, and it can magnify your gains as well. But most of us invest in the market because we are expecting to have some gains. The thing is, a lump sum investment starts compounding faster than intermittent contributions. And that's why borrow to invest is more powerful comparing to intermittent contribution like RSP contributions. In the following slides, I try to contribute a lump sum deposit and compare that to intermittent contributions. And generally speaking, the interests are tax deductible when it comes to investment loans. And what are the risks? As I said, they are like magnifiers. They make the losses bigger. That's why you are more risk in a down market. We are exposed to more risk in a down market. And you have to repay the loan plus interest regardless of what's going to happen to the investment. And you have to have a good credit score to use this strategy. And when you use this strategy, technically you use your credit score. So if you want to buy a house, to buy a mortgage or whatever, your purchasing power would be limited. Okay, I want to compare borrow to invest with RSP. It's one of the most important and interesting comparison I've ever seen. Okay, there we go. Imagine you want to invest $4,000 each year, and for the sake of simplicity, let's imagine you have enough RSP loan, so we are not concerned about your RSP loan, and you are thinking to contribute this $4,000 in your RSP account or in an alternative investment. And the alternative investment is borrow to invest. And you're wondering, why not to get a loan? And the loan amount is $100,000 and invest $100,000 as a lump sum in advance and pay the $4,000 as the interest. So technically, you're thinking of using a borrow to invest strategy versus a simple RSP contribution. The thing is, both are tax deductible. So the $4,000 you contribute in each scenario are tax deductible. If you contribute $4,000 in an RSP, as an RSP, it's tax deductible. And if you borrow to invest, if you borrow $100,000 and you pay $4,000 as the interest every year, the interest is tax deductible as well. So in terms of tax deductibility, there is no difference. Okay, so the assumptions are, let's review the scenarios. You want to invest $4,000 per year, and the loan interest is 4%. And the return of investment, for the sake of simplicity, let's say, is 8% after fees, like MERs or whatever. And your marginal tax rate is 29%. Okay, in this table, I have tried to compare these two strategies to see which one works more efficiently. Okay, let's start with the definition of FMV. FMV stands for fair market value. And as you see, I have assumed the tax treatment of borrow to invest as a capital gain tax. So it's 50%. And the tax treatment of RSP is 100% on your marginal tax rate. Again, please double confirm everything with your accountant. And as you see, when it comes to leverage, after 10 years, you have accumulated $215,892, and when you deduct $100,000 because you have to repay the loan, The bottom line is 115,892, and 50% of this amount, or half of this amount, is subject to tax because it's a capital gain on your marginal tax rate. And if you remember, your marginal tax rate is assumed as 29%. So 16,800 is the tax. And the final bottom line is $99,000. When it comes to RRSP, the amount of money after 10 years is $62,582, and it's 100% taxable on your marginal tax rate, which is 29%. So you have to pay $80,000 as the income tax, and the bottom line is $44,434. So you see it's more than double when it comes to leverage. Okay, this is the second scenario. Let's imagine you want to invest again $4,000 each year, and the interest loan is 4%, and the return of investment after fees is 4% again, and 4% this time because the previous time it was 8%, and your marginal tax rate is 29%. So you see, in the following slide, even when the return of investment is equal to cost of borrowing, you can still make money. Not only you can make money, but also it's more efficient compared to the conventional RRSP contributions. So after 10 years, you see, I don't go through the breakdown of the calculation. I just share with you that the bottom line for leverage is $41,000, and the bottom line for RRSP is $35,461. You see, when the return is equal to the cost of borrowing, it still makes sense to use strategy. And the comparison we have done is with a registered fund. If you don't have any RRSP room and you want to invest in an unregistered fund, or for any reason you want to invest in your TFSA, the discrepancy would be wider. But TFSA, as you know, is not subject to tax. That's the good thing about TFSA. But you contribute in TFSA with your after-tax money. Okay, just want to share with you another video to wrap up this strategy and go to guaranteed investment funds.
Looking to get a head start on your investment goals? Or maybe you need to make up for lost time. With the help of your advisor and B2B Bank, there are ways to accelerate your savings right now. For some, an investment loan can be a great way to fast forward your savings through an initial lump sum contribution. How does it work? Most people build their investment by making regular contributions over a period of time. Each year you contribute, your total investment amount grows. However, each subsequent year, the amount you contribute has less time to grow, creating a lost opportunity for returns. But with an investment loan, you can benefit by borrowing an initial lump sum of money up front to invest. Any potential returns are compounded immediately, meaning that returns are calculated not only on the initial investment, but also on the accumulated growth from year to year. Additionally, interest paid to borrow money to earn investment income is generally tax deductible. Let's review each approach. Say you have $400 to invest each year for 20 years. With a typical savings plan at a 7% annual rate of return, it would take 15 years to grow your savings to approximately $10,000. After 20 years, your investment would be worth $17,546. However, if you took the same $400 and used that for interest-only annual payments on a $10,000 investment loan, the entire loan amount could benefit by being fully invested for all 20 years. Your investment would grow to $38,696, and even after repaying the $10,000 loan principal, you would have $28,696. That's $11,150 more than the typical savings approach. While investment loans have the ability to accelerate gains, they also have the potential to magnify market losses, depending on how the investment performs. When used properly, an investment loan can be a powerful wealth-building tool, but may not be suitable for everyone. If you think borrowing to invest is a strategy that could be right for you, speak with your financial advisor today. To learn more about B2B Bank investment loans, visit b2bbank.com/borrow to invest.
Okay, now you have a general idea in terms of what borrow to invest is. The funny thing is, borrow to B2B bank is not lending money to Bank of Montreal. So my favorite bank is not borrowing money to my favorite segregated funds. But there are other lenders like BMO or Manulife Bank or National Bank, and there are other segregated fund providers like Canada Life, Equitable Life. So we have tons of other options when it comes to lenders or when it comes to segregated funds. Okay. So just to wrap up the borrow to invest discussion, the borrow to invest strategy can magnify both good and bad. So what if we have a fund or a managed fund that the contract locks the gains and the principal is guaranteed in the long run? That's exactly what the segregated funds are about, or guaranteed investment funds. Guaranteed investment funds are like mutual funds, but the thing is the providers are insurance companies. So they have other features. And the most important feature, which is applicable to our strategy, is the reset option, which enables us to lock the gains, the market gains, and the principal guarantees or debt guarantees that keeps the principal safe if something happens to the market, if we face another market turmoil like the one we had in 2008. So guaranteed investment funds benefits. The first thing is the investment is 100% guaranteed, the principal, after the maturity date, which is 15 years, or after death. But it can be as low as 55%. So the guarantee, the maturity guarantee or death benefit guarantee can be 75% or 100% of the principal. The second thing is the reset option. So when it comes to BMO segregated funds, there is an automatic monthly reset option. So whatever the market value is, that value is locked every month. So it helps you to keep your market gains. But the thing is, the option is reset for another 15 years. That's why it's the segregated funds are a perfect fit for borrow to invest. I just want to share with you a short video from Bank of Montreal guaranteed investment funds or segregated funds to discover more how the segregated funds work.
Low interest rates and market volatility is the new reality. Many Canadians are just trying to keep their retirement savings on track. But protecting your nest egg from uncertainty doesn't mean sitting on the investment sidelines. Now your original investment can be guaranteed, and the value of market gains locked in. And now you can enjoy safeguards during volatile times. Introducing BMO Guaranteed Investment Funds. BMO GIFs provide a guarantee that protects up to 100% of your investment. BMO GIFs take the guesswork out of capturing market gains by automatically resetting the value of that guarantee. Along the way, our BMO Volatility Control helps smooth out return volatility. What's more, if you should pass away, BMO GIFs offer a death guarantee. Your beneficiaries will receive up to 100% of your investment or its market value, whichever is higher. Choose from a range of fund choices designed by one of Canada's leading investment managers. And your investment is backed by the strength and expertise of BMO Insurance and our BMO Financial Group partners. BMO Guaranteed Investment Funds. You'll sleep better at night and worry less GIF.
Okay. So, so you see there are a lot of, when it comes to borrow to invest or leverage, we are talking about a broad spectrum of leverage strategies. So some leverage strategies are very aggressive, like the one you can use in Forex market, stock market, or whatever. And some of them are very conservative, like the one we are talking about tonight. And to invest them in a guaranteed investment fund or segregated fund with a lot of guarantees around. So my favorite segregated funds are Bank of Montreal segregated funds because of the performance and the guarantees around the fund. And I think they are a good fit for borrow to invest strategy when it comes to a conservative one. So Canadian Balanced Growth Fund, US Balanced Growth Fund are the perfect fit for this strategy. Money market funds are not good enough. The reason is the returns are not high, so they are not suitable for this strategy. So if you want to see if this strategy works for you or not, the easiest way is to sit down together and discuss your own scenario, because everybody has his or her own risk profile, and we need to discuss about the strategy in details. In 2016, I have the room for $2 million for my clients, and I have the capacity to deal with $2 million in terms of borrow to invest. So if you want to see you are eligible and your credit score is good enough to use this strategy or not, just make an appointment with me. And the easiest way to do that is to go to this website or URL, which is meet.kaylee.ca, and you can make an appointment with me, and it's synchronized with my Google Calendar. So if you can make an appointment there, if you can find a free time there, it means that I'm available at that time, and I will be more than happy to meet with you. There is no fee, there is no commitment. And the worst case scenario is you just come over to my luxurious office in downtown Vancouver, and you learn something new and you discover more. Okay. Thank you for your time and thank you for your attention. And I hope you enjoy the rest of your night. Have a good night. Bye now.